And now, please welcome Managing Director at AB Bernstein, Richard Clarke.
Good afternoon. Welcome to the first session after lunch. I'm Richard Clarke. I'm a Managing Director at AB Bernstein. I'm very, very much the imposter here. I don't work for a travel company. I don't own a travel company. I've never worked for a travel company. But I do spend my days analysing the blue chip equity side of the travel industry. And at Bernstein, we try and take a view that isn't just what's the next quarter EBITDA going to be, how much share buybacks are built into numbers or anything like that. It's very much more we're trying to look at the industry. And so we've partnered with Skift for a number of years. Some of you I may have met at the Skift Forum in London earlier this year. And there's some real synergies between our two business models. So what do I cover? Some of this is relevant today and some of it isn't, but basically, the end result of my job is meant to be to offer advice on these companies on the board as to whether you should or should not buy shares in these companies, but we try and take, as I say, a more long-term industry view of how you should do it. I won't go into my stock recommendations here, but it's really probably the largest non-airline travel companies that form part of our coverage. And so what am I going to talk about as part of this presentation? I've got sort of 10 minutes to distill kind of 7 years worth of work into this. I'm going to talk about where is investor sentiment right now. My day job is out there talking to hedge fund investors, long-only investors. How are they feeling about the travel space right now? I put on the first slide as a title, what are we all so worried about? So, spoiler is going to be they're not particularly positive at the moment, given the macro outlook. But then I'll say, why do I have a slightly different view? Why am I a bit more positive? Can we escape a recession if there's going to be a European recession? Are there offsets to that? How's distribution changing? Is there some blue sky scenarios out there? And then I'll just conclude with a few slides on future development. Just before I start, this is not counting down. I don't know whether it's meant to be, but it isn't, so I'm not sure when my 10 minutes will be up, so I'll try my best. So this is really showing two things. One, it is showing what has happened to share prices of the companies I cover in the travel space since both the beginning of the pandemic, since January 2020, and then what's happened year to date. There's two conclusions from this. One is that in general, the stocks have not done that well. Even though we are kind of out of the pandemic, the majority of the names are still down on where they were pre-COVID. And if you take the example of the S&P 500, which is up 26% since pre-COVID. I think every stock, apart from Hilton, has underperformed that. So every stock in their coverage has underperformed in that space. The second conclusion is there's some real differences between the companies on this coverage. And I think probably the two things you will notice with this is that investors are preferring the US to Europe. So US listed companies, Hilton, Marriott, Hyatt, have done better than those that are listed in Europe. And those with European exposure, Accor and Whitbread, have really underperformed as well. And the other thing you've seen unwind this year is really probably a shift towards people preferring stocks that have got business travel exposure rather than those that are purely tied to the leisure market. So the likes of Expedia, Airbnb down more than 40% year to date, whereas all of those that have got some sort of business travel exposure, still some recovery momentum to come or a vision of recovery momentum to come, have done a bit better. Now, that weak share performance year to date for most of these companies really comes in contrast to the fact that we've continued to see ongoing recovery tailwinds. By the way, if you can't see any of these slides, please just reach out afterwards. I'm happy to share a copy of these slides with everything. But the data has continued to really move in the right direction, probably with the exception of China, but even into November, when we look at the weekly data, that's begun to get better. And so you really, even though people are worried about this macro concern, this macro outlook, what's the consumer going to be able to afford to do, the data continues to be pretty positive. Now, what's the main concern? I suppose the main concern out there at the moment is particularly focused on Europe. I'd say that investors' focus is really on Europe, and particularly, what happens, how is a European traveller, how is a European consumer going to be able to carry on spending when they're faced with much higher energy bills, in the UK, higher tax bills. And we built something called the Bernstein Pain Index, where we looked across a bunch of consumer analysts and said, what is, how much money are we going to have to save in spending to afford higher energy bills? And what buckets is that going to come out of? So if we look at historical trend patterns, how does it come out of? I think the good news we cut from this is really sort of to afford a much bigger energy bill, you're going to have to cut your holiday spend in Europe by somewhere between about 70 and 170 euros per year. And that to me more points to the idea that we're going to see much more down trading rather than just completely stop traveling at all. But this is what investors are focused on. Interestingly, we did a piece of work just recently where we looked at what's the potential upside from China reopening versus if 2009 repeats itself in Europe. And that China reopening tailwind is a bigger positive effect than the recession risk is in Europe. And I think that's where everyone's focused on the negative side, trying to protect themselves on the downside. But there is lots of positive momentum still to come into next year, particularly as Asia reopens. Now, the other question we get asked a lot is hotel pricing. You know, hotel prices, certainly the vision is that hotel prices are very high. They're not as high as flight prices are, but hotel prices are high. What I would say is there is a lot of rationality to hotel prices. Historically, you have seen luxury pricing increase above inflation and more mid-scale hotel pricing increasing below inflation. And that's just continued to happen. I've just put up the Marriott portfolio of brands there. And really the above CPI price increases have only really happened in upmarket brands, which is what's happened historically. So there's nothing particularly unusual about that. Maybe the standout is the Ritz-Carlton there, the luxury hotels. But I think the odd period for luxury pricing was not now, but really the period from 2009 to 2019, when luxury pricing lost its premium relative to the rest of the market. You used to see an ever-growing premium of luxury hotels relative to upscale hotels, and that stopped in 2009. And now we've just rejoined it, and we can talk about where, maybe in the session, why have we rejoined that path? But maybe one way to think about it is that we shouldn't be thinking of luxury hotels as a proportion of the lodging market, but think about luxury hotels as a proportion of the luxury market. So luxury spenders are, they're a separate breed, and they continue to spend in recessions, they continue to increase their payments, and their wealth has increased much faster than inflation and much faster than the price of any of the goods they might play. But luxury hospitality has somewhat been left behind. If we look where the market share of luxury hospitality is compared to luxury goods, yes, of course it came down in 2020 and 2021, but it's still down in 2022, even though every survey will tell you that luxury consumers want to spend more money on experiences, not less. You haven't seen that catch-up come through in market share. So there's still a catch-up to come for luxury hospitality relative to other luxury goods. And then on pricing, even more so. For various reasons, price transparency, the rise of the OTAs, the focus on getting heads in beds, as the phrase is, and a hotel room seen as more of a wasting asset. Hotel pricing has not matched other luxury goods. Luxury hotel pricing has not matched the other luxury goods, either in the pre-pandemic years or through the pandemic. But I think that's beginning to change. You're seeing better pricing algorithms come in, and I do expect that luxury catch-up to come. So I think if there was an investment conclusion from this is that I prefer a skew towards the more luxury plays and the upside they have. Now, what about distribution? Now, history tells you that crises are good for OTAs. We've had the OTAs referred to as dominant by other speakers today. I mean, they're not as dominant as I think some people think they are. They're still only sort of 20% or so. Booking Expedia, still only 20% of sort of hotel rooms booked from them. But crises are normally good for them. They gained a lot of share in 2009, 2010. Something different is happening now. The market share, if we really break it down, apologies, it's a slightly messy slide, but if I compare Q3 2022 market share of the OTAs, this is just Booking and Expedia, to Q3 2019, their market share is actually down. And that's despite some obvious tailwinds from the West outperforming the East, leisure outperforming business, and they've lost market share. Now, who have they lost that to? Again, there's probably a deeper discussion to have. But I would say that one, you've seen some new entrants come in. I know we've got Hopper coming on after me, so I won't steal their thunder, but they've definitely gained share. And I think we've definitely seen the impact of Google in the market as well. Couple more slides. One is I put this one up in Europe as well, but I do think it's something that people are not focused on. People didn't used to take their holidays, and particularly in countries like Japan, US. I'm never sure about this Italy data point. Maybe they just didn't book it. But people didn't take the holidays. We'll talk about this in the Q&A after this. But the pandemic is going to make people freer to take that holiday. They're not going to waste it. No one wants to. They're aware of their own mortality. So this is a huge upside. I mean, if for these countries on the board, there's potentially 26% more vacation days to be taken just by people using the holiday up. So that's really the blue sky scenario. And then just to finish off, a few seconds left, I think when people talk about long-term opportunities, the short-term's driven by the US and Europe, the long-term's driven by Asia, and the Middle East and Africa sometimes gets a little bit left in between. I think the short-term should be more of a discussion on Asia, and the long-term should be much more of a discussion on Middle East and Africa. That region has the least number of hotel rooms per 1,000 capita. It's got the fastest forward growth. It's got the biggest pipeline oversupply by region. And particularly when I think about my big branded companies, Marriott, Hilton, etc., it's the area where they're going to deliver the most growth. 50% growth already baked into the pipeline in Middle East and Africa, much faster than any other region. And if you look at the share of the pipeline in that region from the likes of Hilton, Marriott, Accor, who are the three sort of dominant players in terms of growth in that space, this is going to be a really exciting region. And I think whereas everyone talks about China, we'll be increasingly talking about this region as a region for growth for these big companies I cover. Bit of a whistle-stop tour, but I think we're going to move on to some Q&A now, so thanks for listening to that.